So Mr. Powell says time has come for interest rate cuts and everybody has been waiting for it. Let's analyze in this special episode of Weekend Investing how interest rate cuts have impacted markets, have impacted gold, have impacted crude oil. Uh, and let's look at what past history tells us, whether there is any correlation. Do we need to be scared about it? Do we need to look forward to any fall that a lot of commentators have been speculating? Let's dive in. So this is the interest rate uh, uh, cycles since 1987. So about uh, more than 4 decades of data, roughly 4 decades of data is available right here. And interestingly, for most part of these 4 decades, starting from mid 80s till very recently, the interest rate cycle was continuously downwards. Of course, with bounces on the way, but you can see here that interest, and this is basically dollar interest rate, Fed fund rate. So we were at 10% in late 80s, 10% in the US. Can't be imagined today actually. Coming down to nearly 3 by 1992, 93, post Gulf War, etc. And then it rose back to nearly 6.5% by year 2000, post which there was a dot-com crash, tech crash, and interest rates had to crash down to 1%. And then again, the housing bubble started in the US. Interest rates went up to 5.3%. And then it collapsed from there to near zero during Lehman crisis and the GFC. Stayed there near zero till 2016, was inching up till 2020 when COVID struck the world again. And again, we had to go near zero. And in the last year and a half or slightly more, interest rates have climbed up very, very steeply from near zero to near 5.3%. And the way the narrative is going, it seems like the next phase is downwards. That is the current setup right now. And while the world got used to low interest rates, if you see over the last 3 decades, we are pretty much somewhere near the average. But because there has been a debt explosion globally, everybody has borrowed to their gills during low interest rate regimes. uh, Servicing of that interest rate now is a pain. Bonds that have been issued in the last 15 years, and as you know, there's an inverse correlation: interest rates goes up, bond value goes down, have been bloodletting for the last 2 years. People who have been holding bonds for the last decade have lost all their gains. So there's a lot happening behind the interest rate scenario, and it is hurting. Interest rates had to rise because inflation was rising rapidly, and that is the only tool with the central banks to try and control inflation by increasing interest rate. So now, as they reduce the interest rate, inflation might come back. They may be able to go to 4, may be able to go to 3, maybe not be, may get stunted at 4.5 itself. We don't know. But this Goldilocks scenario that interest rates will go down again to 1 or 0, near 0%, I think is ruled out. So we will see some blip, but then it goes back up again, is my hypothesis. I could be totally wrong on that. So the long term view forward is a bit scary, in the sense that this downtrend, long term downtrend, has been broken. We made lower highs, lower lows till here, and now we are making a higher high. And if we make a low somewhere here and then go up, then the higher highs and higher low series have started on the other side. But you can't do it too much because the world can't sustain it. Everybody has borrowed, as I mentioned. Anyhow, so what happens when Fed cuts interest rates? What happens to gold? What happens to gold in INR? What happens to Sensex in dollar terms? What happens to Sensex in INR? What happens to crude? What happens to S&P 500? These are 6 entities that we have chosen to showcase how they performed when the last 4 cuts happened. So as I showed you here, 1, 2, 3, and 4 cuts of the last 38 odd years, 38, 39 years. Uh, so these are the 4 trajectories that we will see. We are at the cusp of the fifth one. If you see, interestingly, just briefly, I will mention from 1950s till 1980s, there was a continuous increase in interest rates. And since the beginning of 1982, we've had a continuous fall in interest rates. So nobody remembers this now, right? So there was a period where for almost 30 years, the trajectory of interest rates was up. And then post that for 40 years, the trajectory of interest rates was down. Is this, trajectory for the next 30 years up is the question. Because if it is going to destroy a lot of the concepts which people think that, are obvious, that just buy bonds and they go up over time because interest rates continue to fall. So a lot of shift is happening. Uh, there is, the conventional 60-40 portfolio that has come into play in the last 40 years. Buy 60% equity, buy 40% bonds, and you will be doing fantastic, come what may. That 40% has gotten roiled right now, because that 40% is actually bleeding. And people are saying, is that 40% allocation to bonds even the right allocation now going forward? Has gold taken that 40%? Anyhow, I'm digressing from the topic, but coming back to Fed funds rates history, these are the four phases that we are going to see data upon. So phase A, from 1989 to 1993, rates went from 5.2% to 2.9%. Phase B, dot-com crisis, 6.4 all the way down to 1 by May 2004. Then you had 2007 July onwards, 5.2% to virtually zero by 2015. And then recently COVID times, 2019 onwards, 2.4 to 0.08%. So four cases right here. So phase one, 1989 to 1993, this cut that happened. And at this point of time, there was a lot of geopolitics happening, a lot of Cold War, US versus Russia, and also the oil spike that happened during this period. In India, we had the Arshad Mehta spike during this period. So in this period, you had oil go up but come off by 15% over this entire period. Gold was completely flat in this period. S&P 500 gained 58%. Sensex in dollar terms gained 142%. Gold gained 99% in Indian rupee terms. And so you can see gold in USD terms did nothing, and gold in INR terms made 99%, and Sensex in INR terms made 396%. This was the period in which interest rates were cut from 5.2% to 2.9% over a period of approximately 3.5 years. Now, the next period that we have is that of, so just summarizing this, 4.8 years, and you had a phenomenal CAGR in Sensex at 40%. During this period, SPX was 10%, Sensex in dollar terms was 20%, gold in USD terms was -1%, gold in INR terms was fantastic 16%, crude oil was down -3% CAGR. Okay, next phase came when the dot-com crash happened, and I can tell you in this approximately 3.5 years again, uh, markets, Indian markets became extremely dull post the crash. There was virtually no movement in the market till 2003 end, and let's see what other things did. So Sensex still managed 40% in this phase. Gold in dollar terms was up 40%. Gold Sensex in INR terms was 47%. Gold in INR terms was 34%. So all of them did reasonably well despite being a very dull phase for the equities. Oil went up 22%, and S&P 500, the US index, went -16% in this phase. So in both phases so far, US market has not done well, whereas India market has still done well to some extent because of currency moves also. So 3.4 years, interest rate going from 6.4 to 1. S&P 500 -5% CAGR, not attractive at all. Sensex Indian rupees 11%, decent at long term average. In dollar terms 12%. So actually uh, doing better than INR terms. Gold in so the currency was appreciating here, by the way. Gold in US dollar terms 11%, gold in INR terms 9%, crude oil up 6%. Now, third phase came in after it started before the GFC. So July 2007, it started from 5.2%, and it crashed very early, but then it continued to go down gradually till we reached near zero. So it came to about 0.5% or 1% within a year, and then there was a very slow downward move. Um, so in this phase, you had oil go down by 33%. So far in all phases, oil has done not so well when interest rates are down. Gold in dollar terms did 68%, did very well actually. Sensex in dollar terms did nearly 10%, not so good. Sensex in rupee terms did 80%, and gold in rupee terms did 173%. So gold and Sensex again, when rates went from 5.2 to 0.12% over 8 years, uh, again S&P 500 has done nothing versus its long-term average. Sensex in rupee terms also has not done so well, but not so bad also. In dollar terms, nowhere. Sensex completely flat. Gold in dollar terms, 6%, decent, I would say. In INR terms, very good, plus 13%. Crude oil at -5, not doing so well. Now, the fourth phase, a short phase, July 19 to Feb 22. Here you had a year and 2.5 years approximately, going from 2.4 to 0.08%. And here everything sort of was doing well post COVID. Uh, Gold up 32%, oil up 47%, uh, S&P up 47%, gold in dollar terms 46%, Sensex in rupee terms, in dollar terms, sorry, Sensex in dollar terms, yeah, 33%. So all of them doing reasonably well this time when rates were crashing. Uh, as you can see, double-digit CAGR uh, on Sensex in rupee terms, gold in rupee terms. These are more sort of normalized versus past occurrences. And this time, US market also did well. Crude oil also did well during this crisis. So if we compare, US markets versus Indian markets versus gold here, so you will see that S&P 500 on an average gained at 6.6% CAGR across different phases. Uh, Sensex CAGR was average 18%, which is phenomenal. So interest rates falling, Indian markets doing well is a decent correlation. In US dollar terms, also Sensex got about 11%, not bad at all. Gold in US dollar terms did 7% on average. On average, in INR terms, did 13%, which is the long-term average, better than long-term average for gold, which is 11.5%, so 1.5% more than the long-term average. So the summary, if I were to really say, and these are 4 data points, so you need to take it with a pinch of salt, that 4 data points really cannot make a solid conclusion. But what we have been able to see is that Sensex in dollar terms has beaten S&P in dollar terms in all phases of the rate cuts. And rate cuts have resulted in money moving out of US into other asset classes like emerging markets, like gold, etc. So rate cut will hurt the American market more than it is going to hurt us. In fact, it may benefit us in some big way. Last 3 rate cut phases, gold in INR has fared even better than Sensex. So that is the second learning out of these 4 instances, that gold is going to do better than the equity here in India for such time that the interest rates will go down. So this is a huge learning, or you can say insight, that comes here. But again, as I said, this is based on 4 sets of data. So this is not hard line in stone, but the probability becomes very, very high. And then, how you going to play a fall in interest rates is basically have a good asset allocation, have allocation in equity, but don't forget about your allocation in gold, because gold is that one piece that is going to really give you that, extra alpha during this period. And if something goes wrong, if this correlation doesn't work, if the world goes into some sort of a tizzy, gold will still protect you in that scenario. So from all those perspectives, I think having good asset allocation, good exposure to equity, good exposure to gold, I think is the way forward for all portfolios, especially in INR terms. When we are looking at INR investors, we should look at what benefits us. US market may not do well, that is okay. We are not really bothered too much about that. But as long as the money flow comes towards emerging markets, comes towards commodities, comes towards precious metals, and crude stays within some limited range, I think India will really benefit out of the interest rate cuts. Let me know your thoughts on this subject. I hope I've been able to deliver what I was supposed to deliver here. Do send your comments. I read a lot of comments. I try to answer all of them whenever there is a query. Do share these videos with your friends and family. We would like our reach to go beyond the limited 50, 60,000 that we have right now. So please help us, and I'll see you in the next one. Bye.